Cliff, you and I go way back.
We do.
Back to the days of Goldman in the 90s. Background for those that don't know Cliff is he is the co-founder, managing principal, chief investment officer of AQR, a very large asset manager. We're going to go 100 billion. What's our latest numbers?
115.
115. And so we'll talk a little bit about AQR and talk about the business. But before we jump in there, one of the things that I think you might argue with in terms of a description of you is that others have described you, not me, as lovably crabby.
I don't argue with that. I strive for that.
Name a pet peeve that you feel like you're misunderstood. That's a legitimate one that others should have.
One of them, and I'm sure you say this because everyone says it, so don't take it personally. When they look at quants and go, volatility is silly, risk is the chance of a permanent loss of capital. It's not that that's wrong. Of course it's true. If you guarantee me something is not permanent, who cares?
Right.
But rarely do you get that guarantee.
Right.
And volatility in many cases, not all cases, is a fairly good indication of how extreme things might be. That sentence, which I'm sure I've said myself at times, so I'm guilty of this too. Permanent loss of capital, it basically says risk is being wrong. Because that's when you get a permanent loss of capital, when you're never right. And the best risk control being don't be wrong doesn't feel like risk control to me.
The idea that risk is only a permanent loss of capital was the underpinning of the why not 100% equities. But it is a question we get a lot.
So I did write a paper on this. It was in response to a paper that was called Why Not 100% Equities, with a question mark, like implying you should be. Have you considered this? And that paper's argument was simple. You make more money long term. Now keep in mind, you're supposed to. Right? Most basic thing you study when you start plotting different security returns is stocks are probably more volatile and probably have a higher expected return than bonds. And I'm only going to talk about stocks and bonds. We think these same principles apply to lots of other diversifying assets. Go back. I wrote a paper called Why Not, with the not underlined, 100% equities, taking the other side. At some point in your first finance class, you learn that you're supposed to always own a diversified portfolio. And if you're more aggressive than that, you lever it. If you're less aggressive, you de-lever it. And I said, a lot of people won't do this. But this paper I wrote said, what if you actually did it back to 1926 through some crazy marks, through the Great Depression? Your worst cases were no worse, and you made, I forget the number, 100 basis points more doing it. So it's a very fair question to go, I'm long-term, so I should take a very fair observation and say, I'm long-term, I should take a lot of volatility. You can still take that volatility better than a single bet on a single asset class. And leverage, which can be a tool to certainly abuse to take too much risk, can also be a tool to take a far more diversified portfolio, lever it back to a risk level you're comfortable with. In this case, it only required about 30% leverage, about, borrow 30 cents on the dollar. I did a levered 60-40 to get back to the risk of equities. And it just works. Theory works. So I'm not actually disagreeing that a long-term investor should take more risk. I'm saying they should still get the most bang for the risk they take. But if you look at my papers carefully, they are intentionally less useful for making money today than you would imagine. I hope they're useful long-term. How much of this kind of asset the why not 60-40, why you should lever a diversified portfolio paper, that's not alpha. That's not secret sauce. That's something I find very interesting. I think is probably right, and I think worth writing about. So if we come up with something we think is real alpha, we don't write it. This is half a joke, but also half true. The perfect time for us to write a paper is 10 years after we've discovered something and made money from it, and 18 minutes before someone else is going to write the paper. I wrote a piece recently arguing that bubbles are probably more common over my career than they were before my career, and getting a little more severe. I end this piece after arguing that these things will happen more often, saying if you can stick with a rational, active strategy, you should make more money long term. Imagine the other case of perfectly efficient markets. The extreme case, it's not even Gene Fama believes they're perfect. But there, by definition, one definition of a perfectly efficient market is there is no alpha.
Yeah.
So we don't want that world.
Right.
So the more inefficient, you'd think if you could stick with it, the more money you'd make. But the more you will be tested. Less efficient also means the swings away from whatever you consider fair will be bigger and perhaps last longer. And that's as important as bigger, by the way. 3 years of lousy returns can be worse than 2 years of terrible returns. We all are in a client-facing business. And even if your client loves you and believes in you, when you're coming back at the end of year 2, it's hard.
Yeah.
When you're coming back at the end of year 3, it's pretty much you and your mom in the fund.
Right.
And she's filed the paper. She just doesn't have the heart to submit them. But if I'm right, it means the returns to being on the good side of active. Someone has to supply the alpha, the people who are buying into the bubble. But the returns to being a disciplined investor should be larger long-term, but they should be harder to achieve. And I find that kind of fair in a weird way. Harder, but make you more money. That's how the world works.
Yeah. Yeah. Is there a case in sort of the way in which, if the future is as you envision it, for a role of a passive position?
If you add up all the active managers, they sum up to the market,
right?
Minus fees and costs. So active management is a tough game. You have to believe not just that it works on average, but that you are one of the people who figured it out. There's an inherent arrogance.
Yeah.
I have this arrogance. I'm not putting down the arrogance, but to an investor who says, I don't have that ability, or I don't want to put the time in to try to have that ability, maybe they can find someone like you or me who they think has it. Maybe they don't want to do that. But I have no problem with passive. I just think you can do better.
So your point is more that there is a rational strategy that incorporates some passive and some active.
Yeah.
What I've seen evolve over time is that I think it started where passive was the approach that if you didn't have access to smart, differentiated investment talent, it went to passive.
Yeah.
Now, I don't know if you're hearing the same thing, but it's almost reversed, where the hubris is on the passive side, where it's, how could anyone think that they could do better than I could by simply owning the index?
I actually do agree with this. If I had to guess, and again, the average active is 0.
Yeah.
But if I had to guess that what I call the kind of rational side of active, I think it's due for a better 5 to 10 years going forward than its long-term average, which is good, because I do think some things are still kind of extreme, and the passive is part of that.
Right.
I don't know how big a part.
Let's talk about private equity.
Sure.
Your views on sort of how the evolution of the private equity industry has gone, what your view is of whether it does belong in a diversified portfolio?
Sure. Well, first, I think I get billed as too anti-private equity. I've invested in private equity. I will again. I do think there has been a shift, again, maybe since the 80s. David Swensen, probably accurately credited with pioneering institutions getting into this world. He clearly believed, and it's probably true at the time, there was a big illiquidity premium.
Yeah.
That the very act of being willing to invest in illiquids meant you were buying things at a much lower price relative to fundamentals, and therefore had a higher average return. And that makes a lot of intuitive and, in fact, theoretical sense to people, right? Illiquidity is generally, as I say, back then viewed as a bug, not a feature. I don't think everyone, but I think at least a fair amount of the purchases of private, particularly on the big institutional side, now view illiquidity implicitly, not explicitly, they don't say it, but as a feature, not a bug. Because it is easier to hold on to something where you don't have to watch the price go up and down. And the best argument back to me I get, when I say privates are really volatile, you just don't see it. Someone will say, no, maybe publics are artificially too volatile, that privates are more of the true value and publics move around. And I'm actually somewhat sympathetic to this.
Why?
I said I believe there are occasional bubbles. There is, in the academic world, is what's called an excess volatility literature, that prices do seem to move around somewhat more than fundamentals and discount rates should say. I didn't say I fully agree, but I'm directionally, I think the markets aren't perfectly efficient, and therefore swings will be somewhat bigger at least. How much bigger you can argue about. Where I come back to them is saying, why do you get to do it one way and I get to do it another? There are 2 ways you can mark any portfolio, at least 2 ways, but two big ways. One, at what the market will give you for it today. For privates, I certainly wouldn't insist on a fire sale. You could do an orderly sale. But what the market would give you today, you could also mark anything at what you think it's worth. You could do it subjectively. You can have an outside person come in and value it. Essentially, privates mostly go with the second method. Over time, they work the market in a little if it lasts. We go with fully the other method, where we could sell it at today. We are just as capable as them of saying what we think it's worth. And in March of 2000, when we were actually down a lot from inception because we were betting against this bubble, I could tell you when this bubble comes back to what we think is reasonable, we're going to be up 40%, not down 20%.
Yeah.
And in the private world, I could have marked it somewhat close to that. It's a little ironic. I could have said my money's in the bank of short the NASDAQ, which is an odd bank. On the other hand, the private guys are geniuses. The private world, they're the best in the world at valuing individual companies. If you tell them the market's 20% lower than when you bought this thing, I promise you they can tell you what they can sell it at for today. So they can do my way, I can do their way. So professional jealousy and competition makes me go, and there is no economic reason. It is a artifact of legal and accounting and tradition that they get to do it one way and we have to do it another. Their prices on them are really moving, I promise. The only way this matters a lot going forward is if two things happen. If people over-allocate to these things because they think they're very low risk, because they really believe these numbers, and then we have a 10-year bear market when nothing can survive that. The other is if I'm right that in the 80s, there was a positive premium you got for investing in illiquid. If people really love illiquids now because they don't have to ride the ups and downs, they could be overpaying for it. And there could be a give up in return. If a bug becomes a feature, you don't get paid for bearing it, you pay to bear it. So the old assumptions and looking at history, I think privates do belong in a lot of portfolios, but it's much more about believing in the specific manager. If you think you found a manager, like for instance, they have a source of alpha I can only dream about, making a company better. If they're good at that, that is an uncorrelated source of alpha, which is beautiful. So if you think you found a very good private manager, it probably belongs in your portfolio. But if you're going to buy a generic private going forward, I think it's riskier than many think, and I think its returns will not match the history of privates.
Our experience is just that if you do the same level of manager due diligence on a private equity manager as you do on a public equity manager, and you start talking to them about specific positions, and they can walk you through why it makes sense to buy a roofing business at 7 times
It's
EBITDA.
cool stuff.
It's cool stuff. They are harder managers to find because they're the ones who are raising $500 million, not $25 billion. But yet the argument, if they were sitting here with you, I think you'd be doing a lot of head nodding as well. You might still not, or there might be professional jealousy at the way in which they both can charge and then get to mark. But the actual process of identifying attractive, positive alpha opportunities is the same as what it would be in the public equity market.
Well, that's something I say. Most private equity in particular, there are other forms of privates, of course, is mildly levered, long-only active stock picking.
Right.
They're in a different world where maybe they can add value in ways that I can't even touch. So it's not a knock. But that's what it is.
Right.
And so why we think of the risks of that is demonstrably different. Basically, it's people wanting to tie their own hands, to tie themselves to the mast. And if that's a feature, again, you pay for that.
You were really the first I knew, and both of us were very early in our career, to have said, I'm going to go out and do as well as I am able to do on my own as I have been at Goldman. And for me, it was an on-ramp to thinking about starting BBR a couple of years later. 25 years later, you are 27 years later. We are here to live the tale. And, do you ever, think back and reflect, not just about, what the journey has been like, but sort of what were the lessons along the way? What advice would you give to somebody who was at our stage in the career wanting to go do something on our own?
Well, it is hard because a lot of this is bespoke. Different people have different opportunities. It was not an easy leap, but I do think young people, the tech industry is very big on this, and they're not wrong. Failing young is not that terrible.
Mm-hmm.
I think people sometimes hold failure up, which is a definite possibility. A year and a half into our firm, when we had a bad year and a half, I was facing the possibility of failure, but it's not doom. And I did want, for me and my colleagues, wanted to decide our own fate.
Right, right.
I also, if I'm talking to young people, sometimes I literally say, I don't have great general advice for young people. Study hard, not that useful. I do tell them about taking maybe some more risks when you're young
Yeah.
is reasonable. Um, but you may not always feel it, but even if you're flat out only greedy,
Mm-hmm.
if that's all you're out, ethics are a positive net present value project.
Yeah.
It may, like a lot of projects, it may have a negative cost up front.
Yeah.
But long term, almost any real world business case over a full career,
Yeah.
ethics make you wealthier,
Yeah.
not poorer. And people don't get that. Hopefully you do it because you are ethical. But even if you're greedy, ethics are the right choice.
And I think I know you think of this at AQR, we think of this at BBR, which is you're also thinking about your time horizon,
Yeah.
right? And if the time horizon is just your own career, perhaps you can skirt the edges around
Maybe.
the ethics. It's like I can ride it out. But when you're thinking about multi-generational like aspects of how do you keep a business that's built to last, you can't afford those lapses.
Evan, congratulations on 25 years.
Oh,
I'm,
thank
I'm
you.
not going to brag. We hit that a year and a half ago. So, and you may never catch up because that's how time
Can you
works.
pause?
I don't think so. But what you've built here is incredible. The ethics and the way you carry yourself, big fan. Congratulations.
Thanks, Cliff. It means a lot coming from you.